Welcome to the deep dive. This is where your curiosity meets our analysis, giving you a fast track to understanding complex topics.
That's right.
You sent us some really interesting material this week, excerpts from Didier Sornette's book, Why Stock Markets Crash.
A fascinating read.
And it sounds like you want to get the inside track on these dramatic events, why they happen, but without getting totally bogged down in complex finance jargon.
Makes sense. It can be pretty dense stuff.
So our mission today is basically to dissect this whole phenomenon of stock market crashes using Sornette's insights as our guide.
All right.
We'll look at what stock markets really are, dig into some big historical crashes, 87, 29, the 2000 tech wreck.
See what patterns pop up.
Exactly. And then explore this really intriguing idea. Can we actually predict these things?
The million-dollar question, or maybe billion-dollar.
Ah, right. And we'll even zoom out, take a look towards 2050, see what the long-range view might suggest.
That sounds like a plan. Where should we start?
Let's start with the basics. What is the stock market? Sornette jumps right in, challenging that casino idea.
Yeah, that's a common perception, isn't it? You see the wild swings, the speculation, and it's easy to just think, oh, it's just gambling.
But he argues it's much more fundamental than that.
Absolutely. He uses data, like world market capitalization figures, to show its core role. It's basically the engine room for capital exchange in free market economies.
The engine room, I like that. It's how money moves, how companies get funded, how wealth is theoretically built.
Precisely. It's the mechanism that allows these economies to function, to grow. It's not just a sideshow casino.
Okay, so not just random chaos, but then he brings in this concept of complex systems. How does thinking of the market that way help us understand these big crashes?
That's a key shift in perspective. A complex system like an ecosystem or the weather involves tons of interacting parts.
Millions of traders, institutions, algorithms.
Exactly. And their interactions aren't always simple or linear. Small actions, individual decisions can sometimes cascade and lead to huge, unexpected outcomes.
Emergent behaviors, he calls them.
That's the term. Things like crashes might be these emergent properties of the system itself, not just reactions to some big external news event.
Which makes simple cause and effect explanations tricky.
Very tricky. It suggests we need to look deeper than just this news caused that crash.
Right, which leads to that big question you flagged, predictability. If it's so complex, can we see crashes coming? We predict planets, we map DNA. Why not market crashes?
Well, that's the debate, isn't it? Science gives us amazing predictive power in some areas, but Sornette points out that many believe complex systems, especially social ones like markets, have inherent limits on detailed, short-term prediction.
So it's not like forecasting the weather next Tuesday.
Probably not with that level of certainty, no. Think about earthquake prediction, another complex system. We understand the geology, the stresses, but predicting the exact time and place of the next big one, still incredibly difficult.
Okay, so no crystal ball. But what about the random walk model? You hear that term thrown around. What does it say, and why isn't it useful for understanding these big drops?
Right, the random walk idea basically says stock price changes are, well, random, like flipping a coin. Yesterday's price movement tells you nothing about tomorrow's.
So up or down is equally likely, more or less.
In its simplest form, yes. And Sornette shows data, looking at daily versus monthly volatility. That suggests this model actually works okay for the small day-to-day fluctuations.
Hot.
But it completely falls apart when you try to explain the huge moves, the crashes. A 10% or 20% drop in a day just shouldn't happen statistically if it were truly a simple random walk.
It's like saying a light breeze explains a hurricane, as he puts it.
Exactly. Those massive drops are something different. They break the random walk mold.
So the everyday noise might seem random, but the crashes are different beasts. He also talks about informed traders versus noise traders. How do they fit into this picture?
This is interesting. You've got informed traders acting on, fundamental analysis, company value, economic data.
Trying to be rational.
Trying to be, yes. Then you have noise traders who might be reacting to rumors, sentiment, trends, maybe just gut feeling.
Following the herd sometimes.
Sometimes, yeah. Now, classic theory, like Samuelson's theorem, suggests that in a perfectly efficient market dominated by those informed, rational traders, prices should be unpredictable, basically reflecting all known information instantly.
Sure.
But Sornette argues the noise traders are actually essential. They create the trading volume, the liquidity. Without them, the informed traders couldn't easily buy or sell based on their information.
So the noise is actually needed for the market to work. That seems counterintuitive.
It does, but it makes sense. They provide the churn. But of course, their actions can also amplify trends and contribute to volatility, maybe even bubbles.
Okay, fascinating. So back to these crashes. He calls them outliers. What does that mean in practical terms?
It means they are statistically extreme events. If you plot how often the market goes up or down by certain percentages, the normal day-to-day stuff clusters around the middle.
Like a bell curve, maybe?
Sort of, though financial returns often have fatter tails than a perfect bell curve, meaning extreme events are a bit more common than that simple model suggests.
Okay.
But even accounting for fatter tails, Sornette shows calculations like the probability of that huge 22.6% drop in October 1987, and it's still incredibly, incredibly unlikely based on standard statistical models. It's way, way out on the tail.
So unlikely it suggests the standard models are missing something fundamental about crashes.
That's the implication, yes. These events seem to belong to a different category, statistically speaking.
Then he introduces drawdowns, these strings of losses. How does looking at sequences of losses change the picture?
This is another key insight. Instead of just looking at single-day returns, analyzing drawdowns, consecutive periods where the market loses value, reveals hidden patterns.
Dependencies, he calls them.
Exactly. He compares real market drawdown patterns to those generated by standard financial models, like GRCH models.
And
the real market's drawdowns, especially the biggest ones, look significantly different. They tend to be deeper or last longer than the models predict.
so big declines aren't just a series of unlucky random days strung together.
It suggests not. It implies there might be underlying dynamics, maybe feedback loops, that make losses cluster together during these major downturns.
And this difference in the biggest drawdowns, that's crucial for his argument about predictability, right?
Absolutely. That's really central. If the largest drawdowns, the precursors or components of crashes, have unique statistical signatures.
Then maybe they aren't completely random noise after all.
Precisely. And he finds similar patterns not just in overall stock markets, but also in currencies, commodities like gold, even individual large-cap stocks. This ubiquity suggests it's a fundamental property of these financial systems.
Okay, that really sets the stage. Let's dive into some history then. October 1987, you mentioned it was global. What should we take away from that specific event?
Well, 87 is striking for its speed and synchronization. Almost every major market around the world tanked within days or weeks of each other.
Like dominoes falling.
Pretty much. But interestingly, the severity was quite different. Austria saw a relatively mild drop compared to, say, Hong Kong, which got hit extremely hard.
And the cause, did they ever nail it down?
Not really. Lots of theories: portfolio insurance, overvaluation, interest rates, trade deficits. But no single factor universally explains the timing and depth across all markets. It highlights the complexity we talked about.
Right. Which seems different from something like the Dutch tulip mania he mentions. That sounds more like pure crowd psychology.
Exactly. Sornette contrasts 87 with historical manias like the tulip craze in the 1600s. There, the price of tulip bulbs just completely detached from any rational value.
People thought tulips were a sure path to riches.
Yeah, it became a speculative frenzy, driven purely by the belief that prices would keep rising. Everyone jumps in, pushing prices higher, until pop.
Uh-huh.
The bubble bursts spectacularly. That's more about collective delusion.
Okay. What about 1929? What's a key lesson from that crash?
What's interesting about 1929, as Sornette notes, is the optimism beforehand. Herbert Hoover had just won the presidency decisively. There was a feeling of prosperity. The market was surging.
Complacency, maybe?
Perhaps. It shows that crashes don't necessarily happen when everyone expects them.
Yeah.
Sometimes the biggest risks build up when confidence is highest.
Good point. Then fast forward to 2000, the NASDAQ crash. That felt different from 87, especially the recovery.
It did. The NASDAQ, driven by the new economy hype around internet and tech stocks, plunged dramatically over 37% in about 5 weeks.
Ouch.
And unlike 87, which saw a relatively quick V-shaped recovery in many markets, the NASDAQ just kept sliding for a long time. The recovery was much slower, much more painful for that sector.
So different bubbles have different structures and after effects.
Seems so. The 87 crash was broad, systemic perhaps. The 2000 crash was more concentrated in specific sectors, fueled by a particular narrative that ultimately proved unsustainable.
Sornette also brings up rational bubbles. That sounds like an oxymoron. How can a bubble be rational?
Yeah, it's a mind's ender. It's a theoretical concept in economics. The idea is Could a bubble form even if all investors are technically rational?
How would that even work?
Well, the theory suggests prices can deviate from fundamental value if investors rationally expect the price to keep rising fast enough to compensate them for the risk of holding an overvalued asset. Basically, you buy high, hoping to sell even higher to the next person.
Even if you know it's fundamentally overpriced.
Potentially, yes, under specific theoretical conditions like no arbitrage opportunities and shared expectations of continued growth. It's debated, but it highlights how prices can detach from reality even without invoking pure irrationality.
Wow. Okay. But then he does bring in the behavioral side, how our actual human psychology messes things up.
Right. This is where behavioral economics, people like Richard Thaler, comes in. Sornette discusses how real human behavior deviates sharply from those perfectly rational models.
Things like hating losses more than we like gains.
Exactly, loss aversion.
Yeah.
And cognitive biases, mental shortcuts that lead to systematic errors. Herd behavior, the powerful urge to follow the crowd.
Fear and greed.
Absolutely. Emotions play a huge role. He mentions things like the sunk cost fallacy, clinging to a losing investment because you've already put so much in. That's not rational, but it's very human.
And these factors can drive bubbles.
They certainly contribute. Herd behavior especially can amplify trends and create momentum that isn't based on fundamentals.
He talks about informational cascades and contagious speculation, too. How do they fuel the fire?
An informational cascade is when people start ignoring their own information or judgment and just copy what others are doing, assuming they know better.
Like, well, everyone else is buying this stock. They must know something I don't.
Precisely. And it snowballs. He uses an example of a biotech stock, EntreMed, that surged on a news report that maybe wasn't as revolutionary as the initial reaction suggested. The enthusiasm itself became contagious.
Speculation feeding on itself.
Yes, exactly. Contagious speculation.
And it's not just individual psychology, right? He mentions positive feedback mechanisms in the market structure itself.
Right. These are mechanisms where rising prices lead to more buying, which pushes prices even higher, or falling prices lead to more selling.
Like trend-following strategies.
That's a big one. If algorithms or human traders are programmed to buy when prices rise, they amplify the upward move. He also points to how rumors can spread and influence behavior. The more people believe a rumor, the more impact it has, creating its own feedback loop.
He also briefly mentions agent-based models and Herbert Simon's bounded rationality. What's the idea there? Trying to simulate the market.
Kinda, yeah. Agent-based models try to build computer simulations of markets populated by artificial agents traders. But these agents aren't perfectly rational supercomputers.
They have bounded rationality. Meaning what?
Meaning their rationality is limited, just
Yeah.
like ours. Limited information, limited cognitive ability, limited time to make decisions. Herbert Simon pioneered this idea. So these models explore how market-level phenomena, like bubbles and crashes, might emerge from the interactions of these more realistic, boundedly rational agents.
Interesting, sort of building the complexity from the ground up.
Exactly.
Okay, one last concept in this section. Parity symmetry breaking. Positive dividends lead to positive prices. Can you simplify that?
Okay, this is a bit abstract, but fundamental.
Okay.
Why does a stock have a positive price at all? In a purely theoretical world, maybe owning something could have a negative price.
Right.
Sornette suggests the parity symmetry between positive and negative value is broken by things like dividends. Because a stock pays you something positive, a dividend, it becomes inherently desirable to own.
It gives you a reason to want it, breaking the symmetry.
Precisely. That positive expectation establishes a baseline positive value. Without that, in a purely speculative game with no payout, the price might just hover around zero. So dividends ground the value, and then speculation can build on top of that.
Got it. Okay, that's a great foundation. Now let's get to the really juicy part, prediction. Sornette's big idea is that crashes might not be random bolts from the blue.
Right. He argues they might have endogenous origins, meaning they arise from within the market's own dynamics, rather than just being triggered by external shocks.
Built in, almost.
In a way, yes. And crucially, he suggests these internally driven crashes might give off warning signs beforehand, precursory patterns.
And the key pattern he focuses on is log periodic oscillations. What on earth are those?
Okay, imagine the market is developing a bubble. Prices are generally going up, maybe faster and faster. Log periodic patterns are like superimposed wiggles or oscillations on top of that accelerating trend.
Okay.
But the key is that these wiggles get faster and faster as the potential crash approaches. Their frequency increases logarithmically as you get closer to the critical time.
Like a drum beat speeding up before a crescendo.
That's a great analogy. Yes. He argues these accelerating oscillations are a signature of an approaching critical point, or crash.
And where do they come from?
He links them to the way traders might be organized, perhaps hierarchically, and a concept called discrete scale invariance.
Discrete scale invariance. Okay, break that down. How's it different from regular scale invariance, like in fractals?
So, continuous scale invariance, like in many mathematical fractals, means the pattern looks the same no matter how much you zoom in or out.
Infinitely self-similar.
Right. Discrete scale invariance is different. It means the pattern only looks similar at specific discrete zoom levels, like doubling the scale or quadrupling it, but not at levels in between.
Like nested Russian dolls, maybe? Similar shapes at distinct sizes.
That's a good way to think about it. Sornette suggests maybe traders operate or react to information in groups or networks that have this kind of discrete hierarchical scaling property.
And this links to the math of oscillations.
Yes. Mathematically, introducing discrete scale invariance, often represented using complex numbers in the scaling exponents, naturally generates these log periodic oscillations in the real valued output, which in this case is the stock price.
So the math lines up with the pattern. Is there actual evidence for this in past crashes?
He argues yes. Big chunks of the book, chapters 7 and 8, are dedicated to showing data from historical crashes where they've fitted these log periodic formulas to the price action before the crash.
Like which ones?
He shows examples for the 87 crash, particularly in Hong Kong, the 29 crash, the Nikkei bubble, the 2000 NASDAQ crash, and others. The figures often show the actual price overlaid with a fitted curve exhibiting those accelerating oscillations leading up to the drop.
And he even mentions predicting one beforehand. The 97 Hong Kong mini crash.
That's a key point for him, yes. He and his colleague apparently published analyses suggesting instability and a potential correction in the Hong Kong market ahead of the October 1997 mini crash. They even reportedly traded on it successfully.
Wow, okay. That moves it from just backfitting to actual potential forecasting?
It certainly strengthens the argument, though prediction remains incredibly challenging.
What about other events, like the August 1998 turbulence around the Russian crisis? Did the patterns show up there too?
He touches on that period. While maybe not a classic defined crash in the same vein as 87 everywhere, the significant volatility and corrections in global markets then are consistent with the framework. The model can sometimes flag periods of high instability or fragility, even if a full-blown instantaneous crash doesn't happen.
But actually using this for prediction must be hard. He mentions challenges like parametric fitting and non-parametric tests. What are the hurdles?
Oh, absolutely. Fitting these log periodic equations involves estimating several parameters: the time of the crash, the scaling factors, the oscillation frequency. It requires sophisticated statistics.
And you could just be seeing patterns that aren't really there, curve fitting.
That's the danger, overfitting the data. That's why he also discusses non-parametric tests, which try to detect the presence of log periodicity without assuming a specific equation form, making the detection potentially more robust. But it's definitely not easy.
He also mentions the tronics boom back in the 50s and 60s, a historical parallel.
Yes, he draws a parallel between that boom in electronic stocks and later tech bubbles, like a lead up to 29 or the late 90s dot-com era.
Similar hype, similar rapid rise, similar eventual correction.
Exactly. These episodes often share features excitement about new technology, inflated growth expectations, speculative inflows. He shows log periodic analysis applied to the Dow during that tronics period too.
And it's not just for bubbles bursting. He applies it to the long Nikkei decline and something called anti-bubbles.
Right. He analyzes the long, slow deflation of the Japanese Nikkei index after its 1990 peak, suggesting the log periodic framework might also apply to these prolonged bear markets, showing a deceleration perhaps.
And anti-bubbles.
That's the mirror image. A slow, grinding decline, where prices are perhaps below fundamental value, maybe also exhibiting predictable patterns of deceleration. He uses the gold price decline in the early 80s as an example.
Fascinating. Then he looks at emerging markets, especially the 90s boom and bust cycle there. What's the story?
Chapter 8 really digs into this. Huge amounts of capital flowed into emerging markets in the 90s, fueling massive bubbles in places like Mexico, Thailand, South Korea, Russia, Brazil, Argentina.
And the log periodic patterns showed up there too.
He presents analyses suggesting they did, preceding the subsequent crises and crashes in many of these markets. It highlights the recurring nature of this bubble crash dynamic, often amplified by global capital flows and contagion effects.
Contagion one market crashing, triggering falls in others.
Yes, the interconnectedness means problems in one emerging market can quickly spread to others perceived as similar, even if their fundamentals are different.
Lastly, on this prediction front, he mentions market regulations like circuit breakers, those trading halts. Are they effective?
Sornette is a bit skeptical. He points out that in '87, markets with strict circuit breakers didn't necessarily fare better overall.
Why not? Don't they give people time to calm down?
Maybe. But he argues that because major crashes often unfold over several days due to those underlying dependencies, a brief halt might not change the ultimate outcome. It might just delay the inevitable price discovery or even cause more volatility when trading resumes. So maybe not the foolproof protection they're sometimes thought to be.
Okay, that's a really thorough look at the potential for prediction. Let's shift gears now to the final section looking way out, towards 2050 and beyond.
Right, the last chapter takes a very broad, long-term perspective, analyzing trends in things like global population and GDP over centuries.
And he contrasts different viewpoints.
Yes, the sort of pessimistic view, often associated with natural scientists worrying about resource limits and population overshoot.
Malthusian concerns.
Kind of, yeah. Versus the more optimistic view, often found among social scientists who emphasize human ingenuity, technological fixes, and our ability to adapt.
And his own analysis finds something unusual about the growth trends.
Yes, he looks at data for world population and GDP over long periods and finds evidence of super exponential growth.
Faster than exponential, what does that mean?
It means the rate of growth itself has been accelerating over time. It's not just growing by a fixed percentage each year. That percentage itself has tended to increase.
Which sounds unsustainable.
Well, if you extrapolate that kind of accelerating growth, mathematically it leads to what's called a finite time singularity.
A singularity, like in physics, meaning it goes to infinity at a specific point in time.
Exactly. His analysis, based on fitting these super exponential models to historical data, points towards a potential singularity around the middle of this century, roughly 2050.
Whoa. What does that imply? The end of the world?
Not necessarily,
Oh.
but it implies a fundamental breakdown of that historical growth regime, a major transition point.
So what happens at this singularity? What are the scenarios?
He outlines a few broad possibilities. One is collapse. The system overshoots its limits, leading to some kind of societal or ecological breakdown.
Grim.
Another is a managed transition. We consciously shift towards a sustainable steady state or a different kind of growth path before hitting the wall.
More hopeful.
And a third, more sci-fi perhaps, involves a phased transition into something entirely new. Maybe widespread adoption of radical technologies, artificial intelligence, genetic engineering, leading to superhumans, or a post-human era that operates under different rules.
That's a lot to think about.
Definitely pushes the boundaries.
And he links this idea back to crashes.
He draws an analogy. Just like the long periodic patterns signal an approaching crash, a critical point, in the market, maybe these long-term super exponential trends are signaling an approaching critical point for the global human system. He notes similar mathematical patterns have been observed in other complex systems nearing collapse or major transitions, like earthquake sequences before a big rupture, or even studies looking at the rise and fall of civilizations.
So crashes in markets might be a small-scale version of bigger potential shifts in civilization.
That's the provocative idea, yes, that there might be underlying universal dynamics at play in how complex systems approach critical thresholds.
And his final point, the whole economy is starting to behave more like the stock market.
Yeah, he quotes Alan Greenspan observing that the very factors boosting productivity also seem to increase the pace of change and overall economic volatility.
So faster innovation, faster disruption, maybe bigger swings.
It suggests the broader economy is becoming more complex, more interconnected, maybe more prone to the kind of rapid shifts and instabilities we typically associate with financial markets.
Wow. Okay. Well, this has definitely been a deep dive into Sornette's work. We've gone from the basics of markets as complex systems
Through the psychology, the history, those fascinating log periodic patterns.
and all the way out to potential global singularities around 2050. It's certainly given us, and hopefully our listener, a shortcut to grasping some really challenging ideas.
Absolutely. I think the key takeaways are that markets aren't simple random walks. Crashes might have internal origins with potential warning signs, and these dynamics might echo in other complex systems, even on a global scale.
Those log periodic patterns are definitely an aha moment, challenging the idea that crashes are totally unpredictable bolts from the blue.
Even if prediction remains incredibly difficult, just identifying potential precursory signals is a huge shift.
Absolutely. And it leaves us with that final, quite profound thought. If we are potentially heading towards some kind of global singularity or major transition around 2050, how should we even begin to think about preparing for that as individuals, as societies?
That's the question to ponder, isn't it? Definitely worth exploring Sornette's ideas further.
Indeed. Thanks for joining us on the deep dive.